The uncertain pace of the U.S. recovery led Federal Reserve officials to waver over the scope and timing of stimulus. In the minutes from the Fed's January meeting, some members said improving economic conditions mean the $600 billion bond purchase plan could now be scaled back. But most agreed on the need to maintain the emergency help as unemployment really remains stubbornly high. The committee raised its forecast for growth from its November meeting. It's now targeting a range between 3.4% and 3.9%. Yeah, so what have we learnt about the Fed and indeed where policymakers are going to go from here? I want to get some insight now from Peter Dixon. He's no stranger to reading central bank small print because he's been a global equities economist at Commerzbank for more than 10 years now. I'm delighted to say he joins me. Thank you very much, Peter, for taking the time to speak to us. So they raised their forecast for growth. That's what we learnt from the minutes of the meeting. Striking a more optimistic tone, would you say?
Moderately. I think, as you mentioned, there are some concerns that maybe the quantitative easing package which the Fed has put in place is not yet feeding through to give the economy the kind of lift which the Fed would like to see. But I think as we go through the course of this year, we will start to see some very strong numbers coming through from the States, and perhaps some of these concerns that we have in the early months of 2011 will begin to dissipate.
But unemployment's still high.
High now, yeah, but I mean, there are indications that the economy is beginning to create jobs at a more rapid pace, and I think over the course of the next year or two, certainly in the run-up to the next presidential elections, we will start to see the unemployment rate come down. Whether it comes down fast enough for the liking of politicians, of course, is another matter. But I do think that the corner has been turned.
But that's the problem, isn't it? That unemployment isn't. It's the pace. It's not coming down fast enough. When are we going to see a dip below 9%?
Well, that could take a while. I mean, we're on the cusp of that 9% now, but obviously the unemployment rate could go back up again. We had such a sharp fall in the January figure, so I suspect we get some volatility in those numbers. But in the course of the next 3 to 6 months, I could well imagine an unemployment rate below those levels. The question really is, though, is it going to go below 8.5 or 8? I mean, I think once you get below 8, it starts to become less unacceptable. Above 8, it's it's still too high.
But it's not just unemployment, is it? Inflation is below trend as well.
Yeah, inflation is below trend, and the core inflation rate is currently running at a rate below 1%. But again, that does appear to be bouncing off the bottom. Early days, perhaps, to extrapolate a trend too far out, but certainly we are off the bottom. And I think that as the headline figures start to get pushed up by the impact of commodity prices, notably oil, perhaps some of these fears over deflation will start to fade.
Yeah, because we have been seeing volatility in the price of oil, rising commodity prices fueling inflation in many countries, though inflation is still lower than perhaps the Fed would like in the U.S. itself. Does this mean that the fears of inflation risks from QE from some people on the FOMC legitimate concerns?
Well, I think they are, because the problem with the policies like QE is that you put them in place now and you worry about the implications 1 or 2 years down the line when things could be very different. So I think there are legitimate concerns that we could be stoking up inflation, whether it be in prices or in asset markets, the consequences of which we don't see now. And perhaps that shows the danger of concentrating too much on what's happening today without taking due regard of what's likely to happen in the future.
OK, so tell me, Peter, what does all this mean for equities? How should investors take this into consideration and strategize?
Well, the way I see it is that we are seeing a global economy which is picking up, a US economy in particular which is showing pretty rapid growth. And as we've just discussed, the relatively high unemployment numbers mean that corporate America has got its cost base in check. So we're going to see some decent earnings numbers in the course of this year. And given that the returns from other asset classes, notably bonds, are so low, I think we're going to see a continued steady upward progression in equity markets as investors start to reduce their risk-averse stance and look for higher yields.
Right, well, it's good to talk to you, global equities economist, Commerzbank. Thank you very much indeed, Peter Dixon.